Okay, let's start today's webinar. Last week we initiated the coverage on China aviation oil. Here is the brief introduction of CAO. CAO is the largest jet fuel trader in Asia Pacific region and the exclusive imported jet fuel provider to China. It engages in three segments of business: jet fuel supply and trading, other oil products trading, and investments in oil-related assets. Let's look at the corporate structure. CAO is under the parent company, China Aviation Fuel Group Corporation. It has 4 subsidiaries, as shown in the upper orange layer. And CAO's jet fuel supply network reaches to Europe and North America, as you can see. The lower orange layer shows that the 4 associate companies together with CNAF HK, Refueling Limited, which is a joint venture with the parent company, and this makes up the investments in oil-related assets. Now we'll take a look at the macro conditions impact on CAO's business. As CAO's core business is jet fuel supply, we can see that it has strong correlation with the aviation traffic. The air traffic decides the demand of jet fuel. The supply side of air traffic is from the aircraft deliveries. Airbus and Boeing are the major airplane manufacturers in the duopoly market. And their market research reports show that in the next 2 decades, net increment of aircraft deliveries to the world totally amounts to around 20,000, on average 1,000 per annum. And the geographic breakdown shows that the majority of the new orders will go to Asia Pacific region and followed by Europe and North America. Here is quite matched with the global deployment of CAO. The demand side has 2 indicators: RPK, revenue per passenger kilometer, to measure the passenger traffic, and the FTK, freight ton kilometer, to measure the cargo traffic. And these are 2 formulas to calculate these 2 indicators. According to Airbus Global Market Forecast 2015, it shows that the average growth rate of passenger traffic reaches to 4.6% per annum and will double by 2029, which is around 13 years from now. While the Boeing Market Current Outlook 2015 forecasted at 4.9% per annum, which is shown in the gray bar here. Since China is the major supply market of CAO, we specifically analyzed the situation in China. As the chart on the upper left shows that the passenger traffic growth is about the GDP growth, maintaining at double digits except the period of global financial crisis in 2008 and 2009. While the FTK fluctuated a lot, but trending up over the past 3 years. Boeing's estimation of China's growth rate for the next 20 years will be more than 6%, outperforming the rest of the world. Here are the breakdowns of RPK and FTK respectively. We can see that the domestic traffic dominates the traveling flows while the international cargo freight is the main contributor of cargo traffic. The CAO's management gave the guidance that US is the benchmark of China aviation industry development. Based on our research, the US aviation infrastructures are more mature than China. Fundamentally, the numbers of airports and aircrafts are much more than those in China. For example, the airplanes in use in US are around 7,000, but the amount in China is just 4,000 over. The chart here shows that RPK and FTK of US are double or more than double than those in China, but we can see that the gap is narrowing down with year passes because the China's growth rate is much higher than the US ones. So there is no doubt the demand of aviation oil in China will be the top in the long run. Here is the OPEC World Outlook 2015. Assume that the aviation oil demand from China will be 700,000 barrels of oil equivalent per day. Now we'll take a look at how CO runs the business. CO is not subject to the volatility of jet fuel price, which is positively correlated to the global crude oil price. As it uses the cost-plus model, it earns the margin on dollars per barrel basis rather than the percentage of cost. No matter how the price rise or falls, it can pass through and earn the spread between the procurement cost and selling price. However, this only applies to the domestic jet fuel supply to China, so for other regions, CO earns a profit by providing value-added logistics services. And CO has been diversifying the client base geographically and product mix. You can see the pie chart here. Back to FY08, it started to provide jet fuel in Singapore, and it continued to expand the coverage onwards. So until FY15, the revenue contribution from China dropped to close to 50%. Here is the diversification of product mix, which is the second segment of business. The volume of other oil products trading keeps trending up. The pie chart on the left shows that the revenue contribution of other oil products is increasing, and CO sets the target that by 2020 the percentage of revenue contribution from segment will reach 1/3. Investment in oil-related assets is the third segment of the CO's business. Its business is bottom-line driven, which means that the majority of the net profit comes from share profits of associates and joint ventures. The chart below shows that over the past 5 years, the investments in oil-related assets contributed more than $40 million per annum, and it took up almost 70% of the net profit. So among the asset portfolio, the profits from Shanghai Pudong International Airport Aviation Fuel Supply Limited dominated. So the blue area shows that. As you can see that the traffic in Shanghai Pudong International Airport is trending up. The short-term catalysts shown below are assumed to boost the traffic in the coming years. So we highlight this. The Shanghai Disneyland Park is going to open 3 months from now, which is the main catalyst this year. So the FY16 outlook will be focused on potential inorganic growth from M&As. Firstly, CO is holding sufficient war chest fund to buy the right fish. You can see the chart that over the past 10 years, CO has held quite big amount of cash per annum. And secondly, it targets an aviation-related field and aims to integrate the whole supply chain. The M&A targets will be focused on Air Hub International Airport, airspace, pipeline network, and other infrastructures. And lastly, the One Belt One Road initiative paved a good path for CO to seek the M&A targets. Here is the comparison table, peer comparison table. CO actually doesn't have the specific peer as its monopolistic market position and substantial investments in other oil-related assets. We cannot find such a peers that have the similar business model as CAO. But here we listed some segmental peers for reference. So next is the investment risk. For CAO, its major business is credit risk that the counterparty of jet fuel supplier from upstream would default given the low oil price environment. So the company has stringent risk control to evaluate the credit rating and even suspended the business with those failed to meet the criteria. And last part is the valuation method. We use DCF models. In recent years, the days of sales outstanding and days of payables outstanding reaches historical low level, and we assume that these days will rebound, so it will lead to the increase of working capital, and that's why the free cash flow in FY17 and FY18 will drop. And after that, we assume that the free cash flow will back to the average level. So we will have the target price of 92 cents with the return around 60% compared to the last close price. So any questions? So there is a question saying that Disneyland having been set up in Hong Kong earlier should not contribute that many visitors anymore to Shanghai because anyone who wished to see Disneyland earlier would have seen such in Hong Kong. Would Disneyland Hong Kong coming up still contribute that many visits to Shanghai, thereby increase the revenue for CAO? So I think that different Disneyland in different countries or regions have different themes, and also the Disneyland in Shanghai, the scale is much bigger than the Hong Kong ones, and the domestic visitors they will prefer or feel more convenient to visit the Shanghai one rather than Hong Kong. So I think that the Shanghai's Disneyland's open will be a short-term catalyst to boost the traffic in Shanghai. There is questions regarding the Disneyland Shanghai, whether it's bigger than the Hong Kong one and has different attractions from the Hong Kong ones. Um, for those investors who concern the Disneyland issues, can go to their official website as shown on the screen. And of course, the presenting language will be in Mandarin because it's catered for the domestic visitors. And also there is a questions regarding how the Shanghai Disney Resort will related to CO because we assume that the Disneyland Park will boost the traffic flows to Shanghai, and therefore the traffic from therefore it can increase the people who take flights to Shanghai and boost the revenue of Shanghai Pudong International Airport. Because CO hold 33% of the Shanghai Pudong International Airport. Okay, there is also another questions regarding the projected time horizon to reach the target price. Uh, our projection is 1 year. Okay, since there are no more questions, we will end this webinar. See you next week.